Coming Tuesday, I feel better. The Easy Beats, a great tune. Thank you for that, Curtis. 844-RAY-SHOW, emails at raylucia.com, which we'll get to in a little bit. RAYLUCIA.com. Simply click on the Ask Ray button. So before the break, I was talking about the one market indicator that has successfully predicted the past 7 recessions, something called an inverted yield curve. Now, you may recall we've had, since the election, a bounce in Treasury yields. But then, again, if the Federal Reserve continues to ignore the slow growth deflationary signals from the bond market and continues along its current rate hiking path, according to Michael Pinto, the yield curve is likely to invert by the end of this year, and a market plunge and recession is sure to follow. That's not coming from me, by the way. That's just talking about what's happening in the marketplace. Joining me on the show, Steve Aledort knows a little tiny bit about interest rates. Hey, Steve, how you doing there, brother?
Doing well.
Let me finish on this because I would be interested in your comments. Here's what Pinto says. An inverted yield curve, which has correctly predicted the last 7 recessions going back to the late 1960s, occurs when short-term interest rates yield more than longer-term interest rates. Why is an inverted yield curve so crucial in determining the direction of the markets and the economy? Because when bank assets, those are longer duration loans, generate less income than bank liabilities, the short-term deposits, the incentive to make new loans dries up along with the money supply. And when asset bubbles are starved of that monetary fuel, they burst. The severity of the recession depends on the intensity of the asset bubbles. The yield curve, he goes on, inverts when central banks believe inflation is headed higher, but bond investors are convinced of the opposite. Steve, you and I have talked about this in the past. The bond market it's a weird thing because on one hand, you have the Federal Reserve and they're fixing to raise interest rates any minute now. And then you have the bond traders who are looking at the market in toto, and they're making a forecast that sometimes is totally different than what the Federal Reserve is doing. Who's right?
The thing is that it's not really a right or a wrong, and most of the time, I don't know if I'm in using this word, when we're dealing with the bond traders and how they trade the bonds, selling the bonds off, buying the bonds, that will predicate your long-term or 30-year fixed or 15-year fixed mortgage rates. They're betting against what is going to happen, not necessarily what's happening right now.
Well, let me give you my take on it. I think the Federal Reserve is trying to inch up rates to give them some ammunition in their toolkit in the event we do go into some kind of a recession. But as you probably know, it's been the Federal Reserve that's caused most of the last several recessions because of overreactions. I would trust the bond traders, quite frankly, because those bets seem to pay off more often than not.
And I think that you're right on that, and we'll see what happens. And yes, I think that with the pressure that the Feds have received over the last year or so, are we seeing the economic numbers that signal that they should raise the rates? Not necessarily. But I think the pressure of them being expected to do something may outweigh what's actually happening in the market right now.
Well, when rates are at zero, what does the Fed, and you've already, you have a $4.7 trillion balance sheet. What's the Fed going to do? I mean, it starts to get kind of hairy. And so I think again, what do I know? I'm not a macroeconomist, but just trying to put 2 and 2 together, I can see where the disconnect is. Now, I'm not predicting this. I don't do predictions. And frankly, I don't think it's going to happen if Donald Trump can actually focus on his plan for jobs and growing the economy and repatriation and all that stuff, instead of, Twitter wars and fighting the Democrats and the resist movement and all this other stuff, Russia, that's, in my opinion, been a total distraction. And the fact that the markets have been resilient through all of this is quite surprising to me.
And they have. They've been incredibly resilient. We saw an increase in interest rates upwards of 3/4 to a full point right after the election, but now we've seen it come back down. And so rates today maybe are, 3/8 of a point higher than, or half a point higher than at their lows. So we haven't seen a huge movement as it's stabilized after the dust has settled, so to speak.
So Steve Aledort, by the way, loanfinancialplanner.com, my special guest. He's here every week. He's the smartest guy I know when it comes to mortgage loan financing. But more important than that, he is a real loan financial planner. And typically we end up with fantastic strategies for managing your debt on this program. And managing your debt, by the way, doesn't mean debt-free. Be debt-free, yeah. That's all fine and dandy. But sometimes you make money from creative borrowing and smart borrowing. And he's a smart lender, per se, at loanfinancialplanner.com. Steve, on the way over here, I heard mortgage rates being advertised at 3.99%. Last time I looked, it was 4.25. The time before that, it was 4.6. What gives? I mean, again, there's this disconnect in the economy's getting better, the unemployment rate's down to full employment, yet we still have low interest rates and going lower.
Yeah, and there are a number of factors involved, and as we've talked in this one segment here, is that long-term rates are based on how the market trades on a daily basis, based on what the bond traders either buy or sell. And right now we've been hovering at about 2.2% on the 10-year note. If we see that going down to 2.18, maybe a little bit lower, we may see the rates moving down a little bit. If it goes up a little bit higher, then it's kind of hitting a resistance point. But again, interest rates in the last 4 or 5 months have been trading in a real narrow range, and we're actually starting to see them come down, inch down, real slowly.
So what is the 3.99? Is that a bogus number?
No,
or is that real?
Absolutely not. As far as interest rates go, lenders can advertise all types of interest rates. The key is you want to find out what's the cost associated with that particular interest rate. So when I'm generally working with a client, I look to do a loan at 0 points. To me, in most cases, that makes the most sense. But in certain situations, you can buy down the interest rate by paying points, and you can get 3.99, 3.8, 3.75. But there's a mathematical way to determine if that makes sense and what the payback is, getting a lower rate in relation to a little bit higher rate and minimizing your costs.
All right, when we come back from the break, I want to ask Steve about this. Real estate prices have gone up 30% in the last 5 years, 7% last year alone. Is that a great opportunity for a refi now that you've got more equity? And what do you need to do relative to credit score to make that happen? That and a whole bunch more with Steve Aledort, our loan financial planner, right after this. Make sure you stick around for more of The Ray Lucia Show.